Welcome back to the Risk Manager's Corner. It's been a while since our last video, and today we're going right back to the bedrock of risk management: probability. If you're in finance, insurance, asset management, or even just trading your own portfolio, probability is the language we all have to speak. Without it, every risk model, every stress test, every value at risk calculation falls apart. In this episode, we'll break down what probability really means in risk management, sample spaces and event spaces, conditional probability and why it matters in crises, independence versus conditional independence, and finally, Bayes' rule, the tool that lets us update our beliefs when new information comes in. Stick around, because by the end, you'll see how these concepts aren't just academic. They're directly tied to how we measure, monitor, and manage risk every day. Section 1. The foundation of probability. Probability, at its core, measures the likelihood of an event. 3 rules govern everything. 1. No probability is negative. 2. The sum of all probabilities in a sample space equals 1. 3. If events are independent, the probability of both happening together is the product of each probability. That's it. These 3 axioms underpin all of risk management. Think of it this way. When you model defaults, market crashes, or credit downgrades, you're assigning probabilities to future states of the world. Those probabilities drive capital requirements, portfolio limits, and hedging decisions. Section 2. Sample space, events, event space. A sample space is just the set of all possible outcomes. Rolling a die, the sample space is the numbers 1 to 6. For corporate defaults, the outcomes are default and no default. For daily stock returns, the space could be all real numbers. An event is just a subset of that space. For example, sum of dice greater than or equal to 9 is an event. And the event space? That's the collection of all possible events you can assign a probability to. Here's the kicker. Even impossible events, like the empty set, are part of the event space because they're still logically possible to assign probability, usually 0. This is where risk management links theory to practice. Every risk register, every stress scenario, is essentially us defining an event space and assigning probabilities to subsets of it. Section 3. Conditional probability. Now things get interesting. Conditional probability answers, what's the likelihood of event A happening, given that event B has already occurred? This is where risk management lives. Example. The probability of a bank failing might be 1%, but given that another large bank has already failed, that probability shoots up. This is exactly what happened in 2008 with Lehman Brothers. One failure didn't just add risk. It reshaped conditional probabilities across the system. The formula, in words, is the probability of A given B is equal to the probability of A and B happening together, divided by the probability of B. In plain terms, we restrict our universe to cases where B has happened, and then ask how often A also happens in that restricted universe. This leads us to the law of total probability, which says we can reconstruct the overall probability of an event by breaking it down into conditional cases. For risk managers, this is Scenario Analysis 101. Section 4. Independence and conditional independence. 2 events are independent if one doesn't affect the probability of the other. In words, if events A and B are independent, then the probability of both A and B happening together is simply the probability of A multiplied by the probability of B, probability of B. But be careful. Mutually exclusive events are not independent. If A happens and that rules out B, then clearly, knowledge of A affects B. Conditional independence is subtler. 2 events might look dependent in general, but once you condition on another event, the dependence disappears. This is critical in credit risk modeling. Defaults may look correlated, but condition them on macroeconomic states, say GDP growth or interest rates, and suddenly the defaults are independent within each state. Section 5. Bayes' rule. Here's where theory meets decision-making. Bayes' rule lets us update probabilities when new evidence arrives. In words, the formula says, the probability of B given A equals the probability of A given B, multiplied by the probability of B, divided by the overall probability of A. Let's bring it into finance. Say only 10% of fund managers are truly superstars. A superstar has a 20% chance of outperforming their benchmark by 5% or more. A normal manager only has a 5% chance. Now imagine one manager beats their benchmark by 7%. What's the probability they're a superstar? Unconditionally, it was 10%, but using Bayes' rule, it updates to about 30.8%. That's the power of Bayes. It quantifies how new information should change your beliefs. In risk management, this is what happens when we get fresh market data, new credit ratings, or unexpected defaults. Section 6. Real-world example. SIFI failures. Let's take a systemic risk case. Suppose the probability of at least one systemically important financial institution failing in a year is 1%. If that happens, the probability distribution of 1, 2, 3, 4, or 5 failures is evenly spread at 20% each. So while a SIFI failure is rare, conditional on it happening, multiple failures are actually quite likely. This is a classic conditional probability trap. What feels rare may not stay rare once the first domino falls. This is why regulators and chief risk officers monitor conditional systemic probabilities, not just unconditional ones. Conclusion. Probability isn't just abstract math. It's the framework we use to think about uncertainty, stress scenarios, and risk aggregation. Here's the summary. Define your sample space clearly. Remember, conditional probabilities matter more than unconditional ones in crises. Watch out for independence assumptions. They can mislead you. And use Bayes' rule whenever you're updating beliefs with new data. That's all for today's Risk Manager's Corner. If you found this helpful, hit like, subscribe, and drop a comment on how you've applied probability in your own risk work. Until next time, manage risk, don't just measure it.